In 2005, the man who wrote the formula said it himself. Very few people understand the essence of the model. Then he quietly moved to Beijing. David X. Lee was not the only one who knew. Inside Moody's, a managing director was being threatened every time he questioned an AAA rating. Inside AIG, one man earned $315 million building a portfolio of bets no one could pay. And inside the Federal Reserve, the chairman would later call it the intervention that makes me the angriest. Everyone saw the cracks. But the 2008 financial crisis was not a failure of knowledge. It was a failure of silence. In the year 2000, a Chinese-born Canadian statistician named David X. Lee published a paper in the Journal of Fixed Income. It was 9 pages long. The title was dry, almost forgettable, on default correlation, a Copula function approach. Within 4 years, that paper had become the foundation of a multi-trillion-dollar market. No regulator reviewed it. No oversight committee debated it. One academic paper, adopted by an entire industry, with no one asking what would happen if it was wrong. The Gaussian Copula did something Wall Street had been desperate for. It offered a way to calculate the probability that multiple investments would fail at the same time. Before Lee's formula, pricing complex bundled investments, thousands of mortgages packaged together and sold as a single product, was slow, expensive, and deeply uncertain. The math required years of default history, careful modeling of each borrower's circumstances, and enormous computing power. After Lee's formula, the entire calculation fit on a single page. The Financial Times called him the world's most influential actuary. Banks adopted the formula without hesitation. Ratings agencies used it to stamp bundles of risky loans with AAA, the highest safety grade in finance, a designation traditionally reserved for the most secure investments in the world. Pension funds, which could only buy highly rated assets, began pouring billions into mortgage-backed products they believed were nearly risk-free. But the formula had a flaw that Lee himself understood. The Gaussian Copula assumes that extreme events are no more likely to happen together than mild ones. In mathematical terms, it has zero tail dependence. It was a weather model that worked perfectly on sunny days but had no concept of hurricanes. When the model's correlation parameter was set low, as it was during the housing boom, based on recent calm years, it showed that the chance of mass defaults was negligibly small. 2 bonds, each with a 5% chance of failing independently, showed only a 0.25% chance of failing together. But raise that correlation to 0.9, the kind of number that appears in a genuine crisis, and the joint default probability jumps to 4.18%, nearly 17 times higher. No one on Wall Street was running that scenario. Lee saw this. He had built his career on understanding risk, a master's in actuarial science and a PhD in statistics from the University of Waterloo, followed by positions at the Canadian Imperial Bank of Commerce and Barclays Capital. He knew exactly what the formula could not do. In 2005, he warned publicly, "Very few people understand the essence of the model." But the industry had already built its cathedral on his foundation, and Lee did not shout. He did not go to regulators. He did not publish a follow-up demanding the model be retired. He moved to Beijing in 2008, taking a position as head of risk management at China International Capital Corporation. He was never sued, never investigated, never charged with any wrongdoing. The formula was legal. Its misuse was universal. Lee knew. He warned them. But the formula alone did not create the crisis. It needed a stamp of approval. And the people handing out those approvals were being threatened. The entire architecture of modern finance depends on a simple idea that someone trustworthy is checking the numbers. For the mortgage market, those someones were the credit rating agencies, Moody's, Standard & Poor's, and Fitch. Without their AAA ratings, institutional investors could not have purchased the bundled mortgage products at all. Pension funds, insurance companies, sovereign wealth funds, they were all required by their own rules to hold only highly rated assets. The rating mattered more than the reality, and the reality was damning. More than 70% of the dollar amount of collateralized debt obligations was initially rated AAA, the highest possible grade, suggesting near zero risk. The underlying loans, the actual mortgages inside those bundles, carried an average credit quality around B. That is classified as highly speculative. A massive gap existed between what was inside the package and what was stamped on the outside. It was as though a health inspector paid by the restaurants being inspected was handing out perfect scores to kitchens with rats in the walls. Because that is exactly what was happening. Banks paid the rating agencies for their own ratings. If Moody's assigned a low grade, the bank would threaten to take its business to S&P or Fitch. The system rewarded generosity, not accuracy. It rewarded silence, not scrutiny. Gary Witt was a managing director at Moody's. He questioned the ratings. He pushed back on the methodology. He argued that the models did not adequately capture the risk of correlated defaults, the same flaw Lee had identified in his own formula. And when Witt later testified before the Financial Crisis Inquiry Commission, he was asked whether banks threatened the agency when they received unfavorable ratings. His response was immediate. "Oh God, are you kidding? All the time. I mean, that's routine. I mean, they would threaten you all of the time." Witt knew the ratings were lies. He said so under oath to a federal commission. But by the time he testified, the damage was already catastrophic. In 2007, Moody's downgraded 83% of the $869 billion in mortgage securities it had rated AAA just 1 year earlier. 83%. Securities that pension funds had purchased as the safest investments in the world were revealed, almost overnight, to be among the most dangerous. Moody's eventually settled with regulators for approximately $864 million. S&P paid $1.375 billion. Those are large numbers. But no individual at either firm went to prison. No managing director. No analyst. No one. Witt knew. He was threatened for knowing. But someone had already taken those fraudulent ratings and built a $500 billion house of cards on top of them. And that someone had a name. On January 27, 1987, a small team of 13 people began work in a windowless office on 3rd Avenue in New York. They were the founding staff of AIG Financial Products, a new derivatives division inside the insurance giant American International Group. Among them was a young man named Joseph Cassano, serving as the division's chief financial officer. AIGFP operated almost as a separate company within AIG. Its founders had negotiated an extraordinary deal. 38% of all profits went directly to the division's staff, with 62% flowing to the parent company. The division eventually grew to about 400 employees. In some years, its profits exceeded $3 billion. It had offices in Wilton, Connecticut and London, with the London office operating under lighter regulation than its American counterpart. In 1998, Cassano, who had risen to lead AIGFP, accepted a proposal from J.P. Morgan to begin writing credit default swaps. These were, in essence, insurance contracts. If a bundled investment failed, AIG would pay the losses. In exchange, AIG collected steady premiums. It was a spectacularly profitable business model, as long as the underlying investments never failed at the same time. The Commodity Futures Modernization Act of 2000 ensured that these contracts existed in a regulatory void. They were not classified as insurance, so insurance reserves were not required. They were not exchange-traded, so no margin requirements applied. Cassano was selling flood insurance to an entire city built below sea level, collecting premiums year after year, with nothing set aside for the day the levee broke. By December 2007, AIGFP held credit default swaps with a total notional value of $527 billion. Of that, approximately $61 billion was directly exposed to subprime mortgages. AIG did not hold adequate cash reserves to cover potential losses. The company's own models had dramatically underestimated the risk of correlated defaults, the very flaw that Lee had warned about in 2005, the very weakness that Witt had tried to flag at Moody's. Cassano's total compensation from 1987 to 2008 was $315 million, $280 million in cash, $34 million in bonuses. When he resigned in early 2008 as losses mounted, AIG retained him as a consultant at $1 million per month. He continued to collect that fee through September 2008, even after American taxpayers had committed $85 billion to keep AIG alive. In May 2010, the Department of Justice closed its investigation into Cassano. No criminal charges were filed. Prosecutors concluded they could not prove criminal intent beyond a reasonable doubt. Cassano collected $315 million. Nearly 10 million American families lost their homes. But the most disturbing part of this story is what happened next, when the bill finally came due, and the response from the highest levels of government became what one man called the intervention that makes me the angriest. By September 2008, AIG was not simply a company in trouble. It was a node at the center of the global financial system. Its credit default swap contracts connected it to virtually every major financial institution on Earth. If AIG defaulted, the counterparties, Citigroup, Goldman Sachs, Deutsche Bank, Barclays, and dozens more would face immediate, cascading losses. The entire system would seize. Late on a Friday afternoon that September, AIG's CEO Robert Willemstad called Warren Buffett. He asked the most successful investor alive to bid on AIG's property and casualty operations, a last attempt to raise capital before the markets opened on Monday. Buffett went to his office that night, reviewed the materials, and made his decision in less than 2 hours. He called Willemstad back with 5 words that captured the severity of the moment. "Unfortunately, I can't do this deal. And don't waste your time with me, so go someplace else." Buffett's refusal was not a matter of risk appetite. The needed funds for the entire company dwarfed what a property and casualty sale could address. Regulatory approvals would have been impossible to secure by the following Wednesday deadline. And Buffett did not believe the assets were worth the implied price. When the most patient investor in history walks away in under 2 hours, the diagnosis is terminal. On September 16, 2008, the New York Federal Reserve authorized a credit facility of up to $85 billion for AIG. The government received warrants for a 79.9% ownership stake. Over the following months, the total government commitment would reach approximately $182.3 billion, about $112 billion from the Federal Reserve and $70 billion from the Treasury. But the most controversial element of the rescue was not its size, it was where the money went. The bailout funds flowed directly to AIG's counterparties at 100 cents on the dollar, full price. Goldman Sachs received $12.9 billion. Societe Generale, $11.9 billion. Deutsche Bank, $11.8 billion. Barclays, $8.5 billion. Merrill Lynch, $6.8 billion. Bank of America, $5.2 billion. Taxpayers paid the gambling debts of the richest financial institutions on Earth at full face value for contracts that were by then worth far less. AIG posted a loss of $99.2 billion in 2008, the largest annual loss any company had ever recorded up to that time. Its stock had declined 94% during its time on the Dow Jones Industrial Average. The company was required to sell off many of its business units and shed the majority of its employees to repay the government. Federal Reserve Chairman Ben Bernanke, who authorized the rescue, would later reflect, "Here was a company that made all kinds of unconscionable bets. Then, when those bets went wrong, we had a situation where the failure of that company would have brought down the financial system." He called it the intervention that makes me the angriest. The government eventually recovered its investment and turned a total profit of $22.7 billion. But the question that lingers is not about money. If the system worked exactly as designed, if the right people profited and the wrong people paid, then what exactly was the failure? The answer is the most disturbing part of all. The failure was the silence itself. No senior executive from AIG, Lehman Brothers, Merrill Lynch, Citigroup, or any major Wall Street firm was criminally convicted for conduct related to the 2008 financial crisis. Not one. The only U.S. banker jailed specifically for crisis-related conduct was Karim Sirageldin, a former Credit Suisse executive sentenced to 30 months for mispricing bonds. Not for the systemic fraud that destroyed millions of lives, for mispricing bonds. For comparison, the savings and loan crisis of the 1980s and 1990s, a smaller catastrophe by every measure, resulted in more than 1,000 criminal convictions. Between 2006 and 2014, nearly 10 million American homeowners lost their homes to foreclosure. In 2008 alone, 2.3 million homes received at least one foreclosure filing, up 81% from the year before. Nevada saw 7% of all homes receive a foreclosure filing, the highest rate in the nation. California and Florida together accounted for 41% of every foreclosure in the country. The victims were not abstractions. 41% of those who faced foreclosure were under the age of 40. 41% came from the lowest income communities in the country. Subprime lenders had disproportionately targeted Black and Latino neighborhoods, and the damage did not end when the crisis ended. Less than one-third of the families who lost their homes ever returned to homeownership within a decade. Nearly 5 million Americans carried foreclosure flags on their credit reports, and even after those flags expired, they faced persistently lower credit scores and lower rates of homeownership years later. Lee warned about the formula. Witt was threatened for questioning the ratings. Cassano collected his $315 million. Bernanke called the bailout the intervention that made him angriest and signed off on it anyway. The Department of Justice investigated and closed the case. Everyone knew. No one spoke loudly enough, early enough to the people who could have changed the outcome. And the architecture that made all of this possible has not been dismantled. Today, non-bank financial intermediaries, institutions that lend and invest like banks but operate outside banking regulations, represent more than 47% of the total global financial system. Global private credit has reached approximately $3 trillion by 2025, largely unregulated and heavily leveraged. The Financial Stability Board has identified the same structural vulnerabilities that existed before 2008: liquidity mismatches, run susceptibility, and opaque derivatives practices. No equivalent of the post-2008 Dodd-Frank Act has been applied to private credit at scale. The formula has changed. The names have changed. But somewhere, right now, someone knows, and they are not speaking. The silence has not changed.